Welcome in, everybody. It's Ed the Trainer. You know, from week to week, I get emails from those of you who watch these videos pretty regularly, and some requests for topics come up, or they're just straight on questions about our industry. And one of those questions that came up recently was the difference between a closed-end second mortgage or home equity loan versus an open-end home equity line of credit. And that's what's going to come up here next on Tips on Tuesday after this break. So, what's the difference between a HELOC, home equity line of credit, and a home equity loan? If you think about the terminology in and of itself, it's fairly obvious. A home equity line of credit is a line of credit. It's secured by your home, which means it's a mortgage against your house. It's a lien on your property. And in the event that you default, you could get yourself into some trouble. But it works very similarly to the way a credit card works, except it's, again, secured by your house. You're tapping into the equity in your property that's available to you. And usually borrowers that are interested in a home equity line of credit either have something specific that they'd like to use that line of credit for right now, maybe a pool, maybe a deck, maybe some home repair, or there are also borrowers that strategically set up a home equity line of credit in advance of an emergency. Perhaps they're using it as a pseudo-emergency fund straight away, or they're reserving that equity in the event that property values may sink a little bit. For those of you who've been in the industry for a while, you know over the last 5-6 years how much difficulty you may have had with subordination agreements and borrowers' deals kind of blowing up on you because of home equity lines that they had. That second lien holders used that as an opportunity when you tried to refi their first to renegotiate those deals. A home equity loan is a little something different. It instead is a closed-end mortgage that is a lump sum at the start that you pay down, very similar to a first mortgage that is typical of what we're all aware of. A second mortgage that is in the form of a lump sum home equity loan usually is taken out at the start of that borrower's living in that property. In other words, when they purchase the home, a lot of times borrowers use the second home equity loan as a piggyback vehicle, a form of down payment, if you will. In other words, an 80-10, an 80-15, or an 80-20. They're borrowing their down payment, while 20% borrowed down payments now are a little bit non-existent. What happens now, guys, is that these borrowers are paying down both mortgages at the same time. You're not able to access that equity as you pay it down. You're paying it down, and it becomes essentially equity on paper again, not available to you, as it is with the home equity line of credit. Now, which borrower might prefer one or the other, or which circumstances would call for one or the other? It's really specific to your borrower's situation. Nobody's situation is exactly the same. A borrower might choose to use that home equity line of credit, again, like I just mentioned, if they have some plans for home repairs or home improvements, or if strategically they're using it or plan to use it as an emergency fund somewhere down the road. That home equity loan, again, for a purchase scenario, perfectly used there. In some cases, borrowers might want to roll some credit card debt into a smaller second lien as a home equity loan, rather than rolling it into an entirely brand new first mortgage. Perhaps they love their first mortgage right now and they're not interested in getting rid of that altogether, and yet they're a little bit afraid of the home equity line of credit because it's a variable rate often. So a borrower might choose to use a second in the form of a closed-end home equity loan. Again, these scenarios are very specific to your borrower. There isn't a cookie-cutter answer for every borrower that calls on the phone. The point is, they are two different vehicles that we can use, that we have at our disposal to offer our borrower options. And the key is to ask the right questions and arrive at the best scenario for your borrower. And that's what makes you different. It's because you actually pay attention. I hope that helps. I hope you have a great week, and we'll see you soon.